Good morning and welcome to the VIANET Group PLC investor presentation for the 6-month results ended 30th of September 2022. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. You can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to James Dixon, Executive Chairman and CEO, Mark Foster, CFO. Good morning.
Good morning. Thank you all for joining us. We've got a good set of results that really underline the resilience in the business and demonstrate the progress we made to achieving our growth ambitions. Mindful that some of our audience may be new to VIANET, I want to go through a quick overview of the business. Basically, we install hardware and do real-time data capture of operational data. And then we create dashboards, alerts, and insights that allow our customers to transform their business performance. The hardware we either sell or rent to customers, and we have a SaaS model. Our software as a service model, really that's for service packs, licenses, and data services that we enter into 3 to 5 year contracts with our customers, and those are for weekly or monthly payments. Our Smart Machines division now really is comprehensive vending management solutions and contactless payments for the vending industry and other verticals. And Smart Draft is the product of our Smart Machines division, which is really a comprehensive beverage and bar management solution. Our customer base are pretty significant blue chip customers that have been long-term customers of VIANET. If we turn over and look at the reasons why would you invest in VIANET? We've got leading products and positions in significant markets and growth levers that really work for us. If we look at the vending industry, we got 52,000 connected devices in 34,000 machines. And in the UK, there's a machine park of about 300,000 machines. In Europe, 3 million, and globally, there's about 15 million machines. And amongst those 15 million machines, the very large proportion of those, in fact, the vast majority, are not intelligent or connected machines. So that's a fantastic opportunity for us to go at. And within that group, the intelligent machines, their compound annual growth rate is in the region of 5%, which would take it to being an $11 billion market within 5 years. The other factor that works in our favor is the growth of coffee within the vending sector, and we lead in coffee. Our other market is the smart machines smart zones core market, which is the pub sector. And in the UK, there's in the region of 45,000 pubs and bars. That's split about 11,000 each for managed and leased and tenanted, and another 23,000 for independents. Our business is predominantly within the leased and tenanted, although we do have a number of managed outlets in France and the USA and in the UK. In terms of the growth drivers, the levers that are really working in our favor, contactless payment growth, and the introduction of QR code payment works in our favor because we've got market-leading, award-winning contactless payment solutions. And the whole unattended retail sector being driven by people costs and the need for convenience, 24-hour serves, and also the technology. There's much more sophisticated technology in vending nowadays than there's ever been. That allows much more sophisticated products to be vended to a much higher quality. And that, again, works in our favor. the whole remote asset management piece, a light was shone on that through COVID when engineers, people could not access their remote assets, and that's driven a lot of interest in the products that we have, because that's our sweet spot in terms of the technologies that we have. And the whole sort of demand for data and the digital integration, and the hospitality sector in particular, where they're starting to embrace the digital age, is working in our favor as well. And if we then look at other reasons to invest, we have very strong earnings visibility, quality recurring income with high margins, and strong cash generation. So taking that all into account, you look at the markets that operate in. We tick the boxes on the markets, we tick the boxes on the products that we take to market, and we've got a strong customer base that we can grow with. And importantly, we've got a great team. They're motivated. Culturally, we're in a sound place. Instinctively, our people do the right thing. They treat others the way they're going to be treated themselves. And it's a really strong team. Next, turning over the page and look at the progress that we've made. I guess during the pandemic, through the 2 years or so of the pandemic, we continued to invest in our product, our infrastructure, our people, and our customers, creating a bank of goodwill. And the revenues that we're starting to, the revenue recovery now sort of demonstrates that we're going to return a dividend on that investment we made through COVID. Hospitality is back in full billing, and importantly, there's much more desire at a senior level to have the data visibility that we can provide on pubs and bars in the smart zones area. And within smart machines, strong pipeline of contracts, 44 new contracts in the period. That fills our pipeline, which is great news for the future. And I think that whole sort of data demand, the demand for data and contactless payment, that's a sweet spot for us, because that impacts our core markets and gives us access to new verticals. We're demonstrating that the key elements are in place to really provide the growth platform that we need and want to take the business forward. I don't want to steal Mark's thunder, but we'll look at some financial highlights. Now, I'm really encouraged by the good performance. I think since COVID, we moved from a focus on cash is king and continuing to invest to a real focus on growing the top line and sustaining that recurring income growth. That's so important to us. Now, looking at, we tick the box in the revenue growth, tick the box in the recurring revenue growth, which is now 86% of turnover and continues to grow as we feed the pipeline by installing more hardware in the machine parks. Gross margins, really pleased with the gross margin, particularly given the backdrop of much higher component prices, temporary increases due to the global supply chain pressures, and that impacted Smart Machines margins. But overall, we came in with the gross margins being level, so really pleased with that. So ticked a number of boxes there, and strong operational cash generation. And I think the other factor in, I guess during the period, it was our last payment of £178,000 for the Venman acquisition write-down. Otherwise, would have been the loss per share would have been positive. Importantly, we've got a line of sight to growth and cash generation that gives the board confidence that we can return to paying a small dividend in next summer, in July 2023. If we turn over onto smart machines, I'm not going to dwell on this too long, but what I did want to do was sort of give you a feel for our vending market and what we do for our customers and why they continue to invest in our services. Now, what you've got to look at is a vending machine is in effect a small supermarket. It's just remote. Yeah. If you look around the boxes there, now the machine contactless payment, it's that financial integration. We help analyze the revenue share for customers and do all the reconciliation, revenue share, rebates, you name it, we do it. And then you look at now a supermarket, all supermarkets have planograms for all their aisles. Now, we have planograms that we help our customers create for the vending machines. That's the products, the facings, and also the mix. And then the whole insights and analytics piece, what sells when and for how much, and brand owners want their hands on that information. I think importantly, down the left-hand side there, if you look at efficient stock management, well, that's really about ensuring availability in the vending machines, because you don't want to go into a supermarket and see empty shelves, and likewise, you don't want to see an empty rack in a column on a vending machine. And then the whole sort of optimizing the route planning, that's about making sure it's the right stock, not overloading vans, the service, the maintenance. That helps them significantly reduce costs and also reduces the carbon footprint. And really drives those compelling returns that you see in the middle box there. Now, we got a major customer who had in excess of 20% operational savings, and that's before you start to look at the sales uplift. So, fantastic opportunity for our customers to continue to drive their businesses forward. And what we find is that there's a real differential between the customers who are out there and driving the installation of telemetry and contactless payment and being real winners, and when they embrace the technology. So how is that translating to smart machines performance? I guess that investment that we made in the product, the people and customers during the pandemic is really paying dividends. Now, that 44 new contracts on 3 to 5 year terms really feeds the pipeline. And for us, it's really about a case of making sure that the pipeline flows quickly. And we're continuing to do work on that. And then 6,300 new device connections in the period give us a 24% year-on-year growth in the state to over 52,000 connected devices. And that's in 34,000 machines. Strong profit improvement and really achieved despite the fact that we've invested heavily in Salesforce and commercial and continue to invest to drive that growth. The profits were ahead of our pre-pandemic levels, which was really encouraging. And again, strong recurring revenues that only continue to grow. On the right there, Smart Vend, our vending management platform, was launched last month. Now, it's feature rich. It's great news for existing customers who are migrating to it as we speak. It's probably a 12-month program to migrate everyone across to the Smart Vend program. But no, it gives them real incentive to have even more installations of telemetry and contactless payment to drive more data into the management platform. And that feature-rich platform is streets ahead of anything else that's available in the marketplace. And that's going to attract new customers to VIANET. And that whole growth in our connected devices and the data lake that we're creating allows us to then look at developing our market insights revenue as well. So, we now have the market-leading vending management platform to go along with the award-winning contactless payment solutions and website. Now we'll turn over to zones now. Again, to give you a flavour and some colour to the benefits that that really allow our customers to have a compelling return on investment. I guess the way I look at it is that by measuring and acting on some of these key areas, it allows customers to reduce waste, allows them to improve margins. It means that they don't then cut corners, and they can clean the lines at the regular intervals that they're supposed to, which again in turn reduces the waste, helps sales improve, and again it creates a beneficial circle rather than a vicious circle. And if you just look at the post shrinkage piece, we got some big clients in the state where purely the installation of our equipment and integrated to the EPOS, that variance analysis, just simply the act of putting our kit in, saw a 7% increase in sales purely from staff starting to ring in sales rather than pocket the money. So all in all, we provide a really compelling return for customers. Now, if we look at the performance over the past 6 months, I guess our whole Smart Zones business has been very resilient through COVID, other than when we negotiated discounts with our customers during the initial lockdowns. But we've had a full re-opening, back to 100% billing in over 9,900 sites, an 18% increase in the number of new system sales, and that again, those 4 new contracts and 3 contract renewals, that really underpins the solid recurring income that we have in the Smart Zones division. And we believe that we can actually maintain that, which gives us a baseline that will sustain the Smart Zones contribution over coming years. And with the launch of SmartDraft, that will allow us to access adjacent markets that will allow us to get the Smart Zones business into growth. Just in the period, turnover was up 12% at 4.18 million, and operating profit was up 38%, which was a good jump. But importantly, it's that recurring revenue, that's what we're wanting to drive and continue to grow. SmartDraft, during COVID, we did a lot of work in re-engineering, both from a hardware perspective, but also in terms of the software, to actually reduce the cost of our installations, less of a barrier to customers want to invest, and give them a feature-rich platform with features that they asked us to develop for them. Those features being left in keg, so they don't have to go down into the cellar and shake a keg to guess how much is in it. We can tell them how much is left in the keg. The whole till variance analysis, making sure that every pour is being rung through the till, and the whole feeding into stock systems as well. And that's what we've been developing as well over the last sort of 12, 18 months, is our ability to actually prompt orders. So our new sort of SmartDraft launch, it's been launched in the UK in January. That's going to give the site manager everything he needs in seconds every day, which is good news and should allow us to start to drive some further growth in adjacent markets. I'll hand you over to Mark now.
Morning, everyone. I'll just do some key headlines on the main P&L. Turnover is up 13% year on year and is around about 85% of the pre-pandemic level of performance. Recurring revenue remains strong at 86% and over £6 million in terms of actual revenue. Gross margin was up 14%, around about 570,000, with a consistent margin percentage, as Jim referred to earlier on. Our EBITDA grew by 38% year on year, and our operating profit was up 48% to 1.21 million, which was a good step forward from last year. And I'll come on to that to talk about in the divisional performance. From a divisional point of view, Smart Zones turnover was up 460 grand year on year, 12%. As Jim said, we're back to full billing in that state. The contracted recurring revenue remains strong at over 90%, around about 3.9 million. The gross margins were very resilient, and our operating profit was up 500,000, 38% year on year. The full billing obviously helping that, and that's around about 80% of the pre-pandemic level. As Jim referred to, there was 4 new contracts, 3 re-signs, 179 new systems, and the estate is at about 9,900 sites today. In Smart Machines, we had 44 new contracts on 3 to 5 year terms, over 6,300 new connected devices compared to 5,990 the year before, which is just over 5% year on year growth. And the estate is now over 52,000 connected devices compared to around about 42,000 last year, 24% year on year growth. All of that combines to mean that turnover, recurring revenue, and operating profit were all up ahead year on year, and importantly ahead of the pre-pandemic period. So these are the best set of Smart Machines results we've seen to date. Turnover was up 381 grand, 14% year on year, and 300 grand, 11% on the pre-pandemic period. Operating profit was up 14% year on year and ahead of the pre-pandemic period, as was recurring revenue. The margins there you can see took a little bit of a dive, but that was purely due to the stock premiums that Jim referred to earlier on over the last 6-12 months. But those levels of premiums we're not seeing today, so that will start to improve as we go through H2 and into the new financial year. From a cash perspective, we've seen a return to cash conversion that we used to enjoy pre-pandemic. The EBITDA conversion to cash was at over 104%. The operating profit conversion to cash was at 114%. So overall, we had good cash generation pre-working capital, akin to the normal pre-pandemic performance we used to enjoy, and that's where we should be. From a working capital point of view, that was largely impacted by the investment in stock that we made to ensure we had continuity of supply, and we incurred those stock premiums. And we saw the full return to billing in Smart Zones. So year on year, the trade debt position went up, and they were the 2 main factors that caused the draw of around about 700 grand on working capital. In H2, we expect that to normalise a bit more, and some of that will unwind. So we should be in a better position than we are today by the time we get to the year end. We've obviously spent a bit of time investing in Smart Vend and the technology roadmap, which you'll have heard historically. So what we'll see in H2 is the investment in the intangible costs will start to come down compared to what you see here in H1. And the loan repayments have started to come down slightly. We don't have the Venman acquisition loan anymore, which finished in April. Turning to the balance sheet remains pretty resilient as ever. The main changes, obviously, were in the working capital as discussed. We continue to pay debt down. There's no stock surprises coming that we are aware of today in H2. So it's a strong basis to grow the business from, as Jim has been describing.
Thanks, Mark. I hope we've gone some way to demonstrate in a clear line of sight to how we're going to accelerate growth and earnings. We're in the right markets and the trends are working in our favour. Smart Vend, with Smart Vend and the rest of our portfolio for the vending sector, we've got the leading end-to-end solution, clear blue water, compared to the various competitors. And within the Zones division, Smart Draft will enable us to break out of our, predominantly leased and tenanted estate. And we're going to continue to invest. The bottom line is that we want to drive the top line. For too long, this business has been about purely focused on the bottom line. Since COVID, we made all the investments. We put everything in place. We have all the components in place to really drive the business. So it really is about continuing to invest to drive that top line, because driving that top line will build a substantial recurring income stream. And our core platform, we have our two divisions which we will have in growth, but we'll also support entry into new verticals. And in particular, we look at the forecourt sector with almost 10,000 forecourts, best part of 10,000 car washes, jet washes, and also air and vac. So there's a lot to go at in terms of contactless payment solutions, and putting our telemetry in to pull the data back in and give the dashboards back to operators in the forecourt sector, and that's an area that we're targeting. And that quality recurring revenue really is important to us, and we're delivering that growth, and we'll continue to do that. And we're going to be generating increased cash as those sales increase, which has allowed us to pay down debt and puts us in a pretty damn strong position. And I guess just the bottom there, getting back to it, really is about having the right people who are motivated, and we've got a better team than we've ever had. I guess in the time I've been with the business, I've never felt more confident than where we are today. If we look at our aspirations, our top line growth agenda, we have ambitious aspirations for the next 2.5 years. And if we focus on doing the right things well, we've got a fair crack at hitting some of those targets and objectives down there. And there's nothing built into our numbers for the US or the new verticals, but we're going to deliver against them. I guess you've heard a lot about from Mark and I about what we're doing, but I want to finish with what others think of us: our customers, our own people, our teams, and the industries that we serve. If we look at the Best Payment System Award for our trio in the vending industry awards, Best Supplier Website, and the Corporate Social Responsibility, highly commended. It's important to us because we're part of a community in the areas that we operate. And the recognition from our people through independent surveys, and then the fact that they were PCI compliant. That sets us apart from pretty much the competition, our biggest competitors in the payment card, in the contactless payment sector in vending. And there's just a couple of testimonials from customers, but I was talking to one customer a couple of weeks ago, and he said the last thing I would turn off in my pub would be the VIANET draft management system. That's it from me. I'll hand you back to Paul.
Fantastic. Thank you very much indeed for your presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the team take a few moments to review those questions we've had submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. James, Mark, we did receive a number of questions come through, as you can see here. Perhaps I could just start with the first one. It reads as follows: the company has a lot of new and exciting verticals it's trying to enter, including environmental, catering, forecourts, tank monitoring. It's great to see successful field trials and initial orders, but it seems as if VIANET's been knocking on this door for a while now. Would it be fair to say the initial orders have been slow to come through in these areas? And if so, what are the reasons? Is it due to competition or higher barriers to entry, for instance?
Well, I guess from where I sit, in normal times, it probably takes 12 to 24 months to enter a new vertical. I know you've got the initial commercial evaluation, you've got the prototyping, you've got the product development, you've got to determine what the machine protocols are to talk to for machines to talk to machines. And then they've got the technical proof of concept, any certifications required, and then extensive testing and field trials. So there's a lot to do. The pandemic clearly didn't help. That held us back. On the one hand, it held us back, but on the other hand, it gave us the opportunity to adapt some of our existing technology. And if you look at we're in most of these markets, it's about displacing competition as well. So there's contracts that are up. We pride ourselves on the level of customer experience we give customers, and in terms of the quality of our products and our people. So we think we've got we tick all the boxes in terms of winning contracts against the competition, and I'm expecting the next 6 months and full year 2024 to see a breakthrough in this area.
Fantastic. Thank you very much indeed. Next one we've got here, you state that 2023 will be a definitive year for the VIANET's American division. The opportunity for growth there is exciting. How do you intend to capture this future growth? Do you have an office in the US and staff, for instance?
Well, the US is a substantial market. There's something in the region of 70,000 bars and nightclubs, and there's 25,000 fast casual dining chains. And they're the sweet spot for us because they've got between 6 and 10 taps, which is a good number for putting our hardware in and pulling the data out and giving them a good return on investment. And then you got a whole host of independents and hotel chain bars. So it's a substantial market that's worthwhile hanging in. Full year 20, we were pretty near break even in full year 20, just to the end of March 2020. And then, of course, COVID hit. With 300 sites, 250 of those were AMC theatres, and we all know what happened to theatre chains in the States and indeed worldwide. It wasn't good for them, so that set us back a bit. But we continue to get revenue from a couple of fast casual chains where we've been developing additional product features on the Smart Draft product that's going to apply to them, and of course the fact that we've actually re-engineered the hardware to take cost out, and the ease of installation improves and reduce maintenance costs. So we've got a much better proposition to take to those customers in the new year when we look to kickstart again. You think, how do we go to market? We pretty much do all the data management, data processing from here in the UK. We have Micromatic as our field engineering and installation partner on the ground in the States. Then they've got nationwide coverage, and we're going after chains. So that means it's more akin to key account selling. So we've got a couple of people that help us with the key account selling, but it's really about how you get access and warm leads at senior decision making level, and that's something that in the last sort of 12 months. Been making some inroads in terms of establishing some partners that we can work with from a sales commercial perspective, where they have products that are complementary to ours, and Smart Draft fills a gap in I guess that they're offering. So it's a case of watch this space at this moment in time. 2023 will be a definitive year, and I think that's what I said 12 months or so ago, or 6 months ago, I can't remember what it was, but it will be a definitive year, but it remains an exciting opportunity, and I'm personally invested in making it work.
Thank you very much indeed. Next question we've got here is on dividend. I know which we have covered off throughout the presentation, but a bit more of a statement / question. Just to say, as a small investor, dividends are important to me. However, I fully understand, appreciate, and support the reasons for suspending that. So, obviously, the financial health of the company is far more important. I look forward to return to a dividend and dividend growth policy as soon as practical and reasonable. Just in case there's anything further to add there.
I think all I'd add is that when we withdrew the dividend, it was at the time 75% of my income, so I've got a personal interest in it being reinstated at some level, and the business growth should support reinstatement of the dividend. That's why, as a board, we're relatively sort of comfortable with stating that.
That's fantastic. Thanks, James. Next one we've got here is, will the UK's planned shutdown of the 3G network in 23 and 24 have any impact on you and your customers?
It certainly will. I guess the first thing to say is that the shutdown of 3G and I guess 4G and 5G are better, they're faster, they're more reliable. So from a company that wants to have continuity and integrity of data, now 4G and 5G and are really where we want to be. So it's ultimately a good thing, but logistically there's going to be a challenge because there are a lot of customers out there, in pretty much every industry where that has connectivity using SIMs are going to have 3G, and that's all between, I guess. I think Vodafone started the switch off in Basingstoke in February 23, and through to the end of 24, the other operators will look to be shutting off as well. So it's happening. Good news for us is that it creates an opportunity. We have a product suite that is now all 4G, 5G, and LAN enabled. And the shutdown in the UK and the USA, it's going to provide an opportunity for us to work with existing and new customers to basically migrate them to 4G with upgraded technology. We will probably want to get creative in terms of giving them some long-term deals at a low hardware cost, so that we can nail down the recurrent income streams going forward. So it creates an opportunity, and I think it's up to us to be creative and work with our customers to actually do right by them.
Thank you. That's fantastic. And just to say, that's a bunch of the questions I've picked off. But if you could just click on that Q&A tab, just in case there's any further questions that you wish to address before for a few words to wrap up.
We got some additional questions here. I'll let Mark answer the first one. It's a finance one.
Yeah. So I don't know if everyone can see it. I'll read it out. It's from Leo. Borrowings due for repayment within a year, excluding overdraft, seem to exceed cash plus any undrawn overdraft. Please, could you detail the timings of debt repayments and any other loan facilities you have? In essence, we've got a mortgage in our building that's got about 120 grand left to pay. That will be done by June 2023. And today we've got just shy of 2.5 million left of a coronavirus business interruption loan, and that will be repaid by June 26. If we needed other loan facilities, we could go and get them, but as we believe with the plans we have, then the cash generation will deliver. We don't believe we need to do anything around that. And as you've seen in the balance sheet, the trade debt level continues to increase. We don't have a problem with bad debts, and the cash keeps coming in, and the profit converts to cash.
Okay, another question here from Sam E. It's a very large market. Who are you competing with, and how do you get greater penetration, and how easy is it for a client to switch to you? I guess if we take the smart machines market, the vending market first, it is a very large market, and there are numerous competitors. But they tend to do different parts of the end-to-end solution. In payment terms, someone like Nayax, who are listed on NASDAQ, would be our biggest competitor. But we happily go toe-to-toe with them, despite their scale, because we figure that we give a very competitive deal. We have good rates. We turn our cash around in 24 to 48 hours, whereas their cash goes out of the country and can take a week or 2 weeks to get back into customers' accounts. So that's the whole payment piece. You've then got the ERP piece, where the introduction of SmartVend will really be a game changer in that respect, because it is so feature rich that it's so much better than anything else that's available in the marketplace right now. And our competitor in the UK, the biggest competitor, is probably a business called SP Soft, and SmartVend is going to allow us to actually, I guess, make some real inroads. There are various sort of smaller competitors in Europe that we've sort of gone toe-to-toe with on contracts, and where we've competed with them, we've actually won the contracts. We figure that we try to ensure that we give a better customer experience than anyone else. So I think from a product features and usability, user experience, we tick the box there. and whether that's our smart VEN platform or whether it's the contactless payment solutions hardware we have, or whether it's just the people in our whole customer experience team back in the ranch in Stockton-on-Tees. And in the States, Cantaloupe, and I believe they're probably, I think they're listed now. They're almost, other than the payment piece, they're almost end to end, but I would see them as being the competitor in the States. But we're certainly the leader in Europe, and we're the leader in coffee, which is the high margin area. So in that respect, in terms of how easy is it to switch, I think we'll always find a way to do a deal to secure the recurring income stream. So that's where I come from, and it gets to the stage where price isn't everything, and sometimes it comes down to customer experience is important when these decisions are made. And we have all the big boys. This is another one for Mark.
Yeah, from Leo again. Capitalised development costs have been consistently running at 2 million per annum over the last 3 years. How much of this is required to maintain competitiveness? And do you have any large development projects that are coming to an end? There's probably two parts to that question. One is what we're working on now, which I'll probably pass to Jim. But initially, yeah, we've been running at a 2 million run rate over the last few years. As I mentioned in the presentation, we've launched Smart Vend. So some of the development commitment in terms of cost will start to come down. So that run rate will be nearer 1.5, 1.6 million as the months unfold going forward. But we're a technology business. We've got to invest in what the products and services we have. And we continue to work on some of the projects we have, which Jim can probably talk about.
Well, I think Mark has just about answered the questions there, but no, we'll continue to work on the Smart Vend piece. We'll continue to work on developing an inventory solution that we can bring to market in the UK and Europe and also in the States for the hospitality sector. And we'll continue to work on the market and data insights piece as well. But our overall R&D spend should stay relatively stable at the lower levels that we've been achieving in the last couple of months.
Yeah. There's no more questions that we can see here.
Fantastic. No, you've covered every single question off, so thank you very much indeed. Of course, any further questions that do come through, the team will be able to review those, and we'll publish responses on the Investor Meet Company platform.
Oh, we've got one late question, Paul.
Yeah, go for it.
For Mark.
Yeah, from Chris E. CapEx is reducing due to launch of Smart Vend, but is that cost out, or does this CapEx now return to become OpEx? Well, it's an intangible asset. It's the people investment in developing the technology in Smart Vend and others that we're working on. So that becomes an intangible asset in the balance sheet, and that will be amortized over current policies 5 years. So it becomes a P&L item below the operating profit, but ultimately is a cost net in PBT.
Fantastic. Again, thank you for taking that last one. James, before redirecting investors to provide you with their feedback, which I know is particularly important to you, could I just ask you just for a few closing comments, please?
Yeah, I guess I think it is about the fact that we've now got all the components in place, and I guess I personally have never felt more confident about our ability to deliver, in the short, medium, and long term, the sustained growth and earnings growth, and just achieving some of the, I guess the aspirations that I took you through in the presentation. Just achieving a portion of those is going to see our valuation improve dramatically. It really is about us starting to demonstrate that the growth potential that's always been there is being delivered. So, and look forward to reporting back to you in 6 months' time.
That's fantastic. James, Mark, thanks indeed for updating investors today. Can I please ask investors not to close the session, as you'll be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete, and that is greatly valued by the company. On behalf of the management team of VIANET Group PLC, we'd like to thank you for attending today's presentation, and good morning to you all.